Hi, my name is Jordan Wilson. Today we're going to take a look at the advantages of using a buy and hold investment strategy. I'm kind of two minds on buy and hold. I like it. I think it works quite well. I tend to recommend it to investors. On the other side, I don't think it works overly well for non-diversified assets. The Eastman Kodaks, the Blockbuster videos. I'm not sure there is truly a company that you can buy a share of that is a buy and hold. And I know people will say Coca-Cola, maybe a Berkshire Hathaway. But if we look back, there's enough flux and change in the environment, in the industries, and the technology that the days of buying an Eastman Kodak in 1930, throwing it in your safe deposit box and forgetting about it, I'm not sure that'll hold the test of time going forward. And it didn't last the test of time if we look back 20 or 30 years. There's just so much flux out there. So I do like the buy and hold, but I think it needs a few tweaks. So today we're going to look at some of the perceived and actual advantages of using buy and hold. The first advantage is that it's easy. It's easy to understand. You like shares of Tesla, or you like shares of the S&P 500 as an index? You go out, you buy it, and you hold it. Simple to understand. It's easy to implement. Buy and hold. It's easy to maintain over time. Buy it, forget it. So very easy. And I think when we look at disadvantages, we'll also see that ease can be a potential disadvantage as well, because I'm not sure that, as I said up front, that you can just go buy something and forget about it. It's a little bit more complicated than that. But the buy and hold philosophy is quite easy to understand and maintain and implement. Buy and hold is consistent with investment theory in the sense that assets over time appreciate. We saw this in previous episodes where over time all asset classes, even minimal cash T-bills, will appreciate. And as we saw, the higher the investment risk associated with an asset, the greater that return over time. So if you buy something today and you plan to just hold it for 50 years, it will appreciate. Now, you also need to look back at our discussions on systematic and non-systematic risk and diversification. Because again, if you're in a non-diversified asset, like Enron, or Nortel, or Bre-X, and so on and so forth, you have so much stock-specific, non-systematic risk associated with any one non-diversified asset. So if we're in the S&P 500 and suddenly Eastman Kodak or Blockbuster goes belly up, yeah, that hurts, but you're spreading that risk out amongst other companies that are doing well. So again, that's diversification. But over the long haul, buy and hold is consistent with investment theory. I think a true advantage of buy and hold is that it promotes better investing habits. Primarily, it takes emotion out of the equation and improves your discipline. And I think those obviously go hand in hand, but strong investment discipline leads to investment success over the long haul. If you're worried about the markets crashing and you jump out, and you're worried about the markets rising and you jump in, we saw again in prior episodes that market timing is incredibly difficult, even for the professional asset managers. In one episode, we looked at if you just missed out in 20 years on 20 or 30 or 50 of the best days the market had, you could have lost 80% of your potential growth. So it's difficult to get the market timing right. And if you miss out on some of the good days because you got it wrong, that will hurt your compound growth over time. So again, the buy and hold, you're not worried about the market volatility. You're just riding this out for the long haul. And that reduces your emotions, reduces your activity, and helps build the discipline that's needed to consistently grow a portfolio over time. Another advantage is that passive investing tends to outperform active management. And again, we saw these lessons in prior episodes. It's not just market timing. It is difficult on a long-term, consistent basis for active asset managers to achieve alpha. And alpha is the ability to outperform their benchmarks. And the benchmarks are going to be the passive indexes. So it's surprisingly difficult for active managers to outperform. And again, to me, that's a point that we just have to keep going back on, because even as someone like myself that has read all this stuff and works in it, it just intuitively does not make sense. If I have the S&P 500 or the TSX 300 or even the TSX 60, I should be able to identify the 10, 20, 30 best stocks in that index, and the 10, 20, 50, if it's the 500 index, 100 of the weaker stocks. So I should load up on the good ones, underweight or eliminate altogether the weaker ones, and I should easily beat the benchmark because the benchmark is exposed to everything. So why is it when we looked at actual performance of the professional money managers that they don't achieve this alpha, that they don't outperform their benchmarks? And yes, a large part of that is their costs, because the more work that you do, the higher the cost. But again, we've seen this building up to today, is that passive tends to outperform active. And I'm not sure you can get much more passive than a pure buy and hold investment strategy. Another thing that we just looked at was dollar cost averaging. And we saw that over time, because assets appreciate, lump sum investing should outperform dollar cost averaging. But the big caveat there is that how many of us, without ample cash reserves sitting around to invest, have the cash to make that lump sum investment on day one? We have to build over time. So in reality, I think for most investors, dollar cost averaging works well. It also promotes good investment habits, less emotion, more discipline, more consistency. It's easy with dollar cost averaging to diversify. And dollar cost averaging meshes very well with buy and hold. You do your research, you find a best in class quality asset, Maybe that's the lowest cost, minimal tracking error S&P 500 index if you're interested in the US larger cap equity market. Or it could be a European fund, or a Japanese fund, or a bond fund, whatever. But you do your research, you find your best in class, you make your initial purchase, and then you dollar cost average and increase your position over time. You hold the asset until you reach your financial objectives time horizon, and then you sell. So buy and hold and dollar cost averaging work very well together. Another advantage, which is a real advantage, is the low cost. If I'm actively trading, jumping in and out of Coca-Cola or the S&P 500, I'm going to generate transaction fees. If it's an ETF, every time I buy or sell, unless it's a no transaction fee fund, I'm going to pay that $9.99 or that $6.99 transaction cost to my broker. Buy and hold, you're not generating those costs. You're also not generating tax or triggering tax when you sell. And we're talking here a non-tax deferred investment account. So if I own those Coca-Cola shares and they've gone up 20% and I think it's time for a correction and I sell, then I'm going to generate a capital gains tax on those dispositions. Whereas if I buy and hold, I'm deferring the tax until the ultimate sale date, which, if it's a share like Coca-Cola, maybe not till retirement. So it's much lower cost. So I think buy and hold is a good strategy, especially because it works quite well with the passive management that we've talked about to date as a very useful tool for investors. It also works very well with dollar cost averaging. So as you see here, if we're going to promote a passive investment strategy using dollar cost averaging, the buy and hold does make sense. That's all I want to talk on today. Next time up, we'll look at some of the perceived disadvantages of buy and hold. And by perceived, there's stuff that you'll read about, but I don't really think at times they're legitimate criticisms. We'll get into the legitimate criticisms of buy and hold following that. And there are some that make it less than optimal at times to use buy and hold. But then we'll follow up by how can we tweak buy and hold, or when is buy and hold better? When is it worse? When should you avoid it? And we'll cover all those things in subsequent episodes. Thank you for listening in today. Have yourself a good day.